Olix Network 18, Mission Poshan, Bhavishya Roshan.
Good morning. Welcome to Bazaar Morning Call. This very special edition of Bazaar is coming to you all the way from, as you can see, the Morgan Stanley 20th Investor Summit. In a bit, we are going to have Morgan Stanley's chief global economist, Chetan Ahya, with us. You can't ask for a better guest on a day when, of course, we will have all our eyes pinned on the monetary policy that will be announced at 2:30. Good morning, Surabhi and Sonia.
Hi, Lata. Good morning. Hi, Surabhi. Good morning. Yes,
Sonia. Good morning,
the
Lata.
RBI policy, everyone's going to be talking about that. But apart from that as well, Lata, the market has been falling under its own weight. In fact, Surabhi and me and Closing Bell yesterday were looking at how the mid-cap carnage has accelerated, now down 14% for the index itself this year.
Oh, absolutely, Sonia. But you know what I was just thinking, just looking at data and how we're stacked up, whether for today the bulls will get maybe some sort of a relief. The thing being that we are coming on 3 successive days of selling, so Friday, Monday and Tuesday. B, global cues have always been okay. They have not been a problem. That continues to be the case today. In fact, oil is still very range-bound. You've got about 75 on Brent, so that hasn't changed. Asian markets are quite okay for the time being. So global cues aren't really much of a problem. This is the point that we'll discuss with Lata, actually, that maybe the worst of the hawkishness from the Reserve Bank of India is already in the price, whether you're looking at bonds or whether you're looking at equities. We've seen that decline on the banking stocks and Nifty Bank as well. So after 3 days of selling, are the bears going to just pause for breath? Though, of course, medium-term issues really remain with the way mid-caps are falling. We saw some value buying emerging in select NBFCs and stocks like Tata Global yesterday. But whether we can really see the worst of this mid-cap fall is over, that's, of course, a separate debate. But, Lata, your sense on the policy and whether the hawkishness is really now in the price?
Okay, well, 2 things. Just to add to what you're saying, we could be getting into oversold territory. 10,580 is seen as a very strong support level, and we did see the market bounce back from that point yesterday. So it's quite possible that from oversold terrain, we will not see further selling, but perhaps a bit of covering. Separately from the policy, see, in the first place, a rate hike is actually a sign of growth. Why do central banks hike rates? Because they think growth is good, it doesn't need a crutch. As well, the output gap or the excess supply, excess overcapacity in the economy is closing out, and now producers will start raising prices. So if a conservative institution like central banks are telling you that excess supply is over, there is so much demand that is growing, that's a positive. So a rate hike always should be seen as the central bank saying that, giving it a green tick for growth. And the second point to note is, as you have been discussing, and as has been the stark trend year to date, is that a lot of the yield rise has already happened across the curve. Even the 2-year paper is at 7.6, the 10-year has gone to 7.9, CPs, CDs, just about every debt instrument from Jan 1st to now, yields have risen by about 1.4 percentage points. So most of the hike is in the price. The worry will only be, you'll have to look at the conversation. If the voting is 4 people vote for a hike and 2 people vote for a pause, the market will not take it very badly. If 5 people vote for a hike of 25 and 1 Michael Patra votes for a hike of 50 basis, then that can be seen as hawkish. And then, of course, you'll have to come to the statement. If the statement looks like this is the start of a series of hikes, if something in the statement say that, then the market can be a little worried. Of course, the market will also worry whether the Reserve Bank says something about financial tightening hurting growth, anything like that. Those are the things to watch out for, the voting pattern as well as what the RBI says. Otherwise, a rate hike supported by 4 members and 2 voting for a pause will actually be in the price, and I don't think the market will move beyond 7.9.
Okay, well, let's actually also take a look at the Nifty, because the 100-day moving average, we were talking about the key support levels, Lata. The 100-day moving average of 10,550 was held yesterday. So let's see if that holds, because, as Ashwini was also telling us yesterday, these are a couple of crucial levels that have been breaking on the downside. So it's important to keep that in mind. Also, this BSE adding those stocks, additional stocks stocks to the ASM list. That actually spooked a lot of the stocks yesterday, because now 400 stocks of the BSE hit lower circuit yesterday. So that's, I think, something to watch out for as well.
So, Sonia, I wanted to just place one more thing on the table. I've been speaking to a lot of mutual fund managers, CIOs, CEOs, etc., to find out if these institutions are contributing to the mid-cap fall or not. Because everybody talks about the SEBI circular and the churn that's been happening and funds are merging. But that's not the case. The sense that I got was a lot of that churn is anyway over. I mean, it's at the fag end of it. And if anything at all, some of the mid-cap funds have had to buy more from the market because the mandate now is that you have to have at least 65% in mid-cap or small caps if you're a fund of that variety. So the sense that I got from that fraternity is that they're not really contributing. This is more of ASM and these other issues that have cropped up in the past.
All right. In fact, we're waiting for Chetan Iyer to join us from the Morgan Stanley conference. But in the meantime, let's also tell you what our wise experts have to say as we head into trade this morning. Mahesh Nandurkar of CLSA says oil is now firmly above $75 per barrel. He says this, coupled with other commodity price increases, a depreciating rupee and hardening yields, will have an impact across their coverage universe. He says given initial inventory gains, the gross margin impact was limited in Q4. However, he adds Pidilite, Century, Supreme and Astral are most vulnerable to the effects of the rupee depreciation and rising crude prices. He also adds Crompton, Havels and TTK Prestige are relatively better placed as incremental inflation in rupee-denominated non-ferrous prices has been muted. He says Arvind should be a net beneficiary from the rupee depreciation, and he says most companies in their coverage are not leveraged and hence unlikely to see a large impact from rising yields.
Okay, let's also get you an equity call. Surendra Goyal of Citi says valuations continue to look high, with the Nifty trading at one standard deviation above mean despite optimistic forward earnings expectations. He says mid-cap multiples are still expensive despite the correction. Also adds that earnings yields gap has widened sharply. Citi India sentiment indicator suggests modest single-digit returns in the year ahead. Surendra says their key overweights include financials and autos, while their key underweight is IT. Citi makes multiple changes to their model portfolio by adding Sun TV and replacing Voltas with Cummins. He adds that Citi initiates a holding in SBI Life Insurance, that's their top insurance pick, and initiates a small holding in Idea. Ambuja, Ultratech are their top picks in cement, while Tata Steel, Hindalco remain their favored picks in metals.
Okay, it's important to track the money markets this morning, considering we have the RBI policy. Yesterday, the rupee closed lower against the dollar. 67.15 is where the close was. Pramit Brahmabat of Veracity says ahead of the RBI's monetary policy announcement today, he expects the rupee to consolidate. He says the spot dollar INR pair is likely to trade in a range of 66.80 to 67.20.
Dhaval Dalal of Edelweiss AMC says the bond yield curve is likely to experience a bull flattening amidst the recent change in the FPI investment guidelines, which will have a positive impact on that short end of the yield curve. He says replacement of the 10-year government bond auction with an FRB may also aid positive sentiment amidst recent correction in Brent crude oil prices, reduction in geopolitical risk and allaying of concerns of potential trade war. He adds that all eyes are on the trajectory of the US dollar in the near term. He's expecting the 10-year benchmark bond yield to trade in a band of 7.65 to 7.75% in the near term.
Okay, those are some money market views, but let's talk about the world view now. In fact, you know, the US markets have had it good. The Nasdaq hit a record high yesterday. Nigel is here for the world view. Nigel.
Well, that's right. The US markets ended more or less mixed, but the Nasdaq, that's the star in there. It was buoyed yesterday by gains on a couple of stocks. We had Netflix as well as Amazon. Both those two stocks did well, and that's why, in fact, the Nasdaq was the star. The trade worries, though, they continue to move on. The broader markets are looking a little worried there. We had a word coming in from the economic advisor, that's Larry Kudlow. He says that President Trump will hold separate talks with Mexico as well as with Canada. So we'll keep an eye out on that front. Well, the US economic data continues to look good. The ISM non-manufacturing index, that came in above expected 57 odd. It came in at around 58.5. So that looked pretty good. European markets, well, it was a mixed bag over there. The DAX was a relative outperformer, while the FTSE was an underperformer. With good reason, because some of those banking stocks did sell off in yesterday's trading session. We had RBS that was under some pressure on talks that the UK government is looking to sell part of its stake. Italian index was under pressure, reacting to a speech coming in from the new Prime Minister, while in fact the emerging markets as well did see big selling. Asian markets a mixed bag today. but Brent crude prices have cooled, and that'll be something that, in fact, our markets will take note of. For the time being, the SGX Nifty is indicating a flattish start.
Okay, thanks a lot for that, Nigel. But what is on the RBI governor's mind and how are the macros stacked up? Over to Lata now, who is at the Morgan Stanley Investor Summit with a very special guest. Lata, over to you.
Thank you very much. Yes, Chetan Ahya is with me. Chetan Ahya is the global economist for Morgan Stanley. And at this point in time, we first have to get the global macros right. So, Chetan, you know, I was reading your one of your latest reports. You all are almost seeing a Goldilocks scenario for the world. The global economy growth doesn't look like getting impeded, and inflation won't be such a big threat.
No, all what we are saying is that there are challenges. You are seeing problems in terms of central banks tightening in DM, and so that's going to be definitely some kind of a challenge for growth to continue. But to the extent to which this cycle has been driven by capex and productivity, which has really happened for the first time after the deceleration in capex that we saw since 2012. And so to that extent, it is on a much stronger footing. It takes a lot for a capex-driven cycle to be turned down by the challenges that we are seeing right now.
You know, some of the things that keep that are brought to us as red flags. One is that even in the US, the difference between the 10-year yield and the 2-year yield is now, it's almost leading to a flattening curve. And so is there a recession? Fears like these are unfounded, you think?
So actually, I think the comparison on that front would be 90s, when yield curve was flattening, and it was relatively around 50 to 75 basis for a long period of time. And guess what was similar to this cycle? Capex was strong. So if you have productivity-driven, capex-driven growth, then the economy can withstand higher interest rates and does not have a problem then.
Okay. So what about EMs then? Do you think they benefit from this? Or, lately, look at the outlier. Maybe these are only outliers, Turkey, Argentina, but even Indonesia had to raise interest rates. So is there a fear of, dollars moving away from emerging markets?
So look, Lata, the way we approach EM's outlook is that we need to first see how their own policy mixes and macro stability indicators are. And then you evaluate that in the context of rise in interest rates in the US. Now, and in that context, taper tantrum and commodity price fall in 2014-15, we think were the triggers. The reality was that these guys were misallocating. So now when we take all the large EMs, bulk of them are doing fine on policy mix and therefore on macro stability indicators. Look, Indonesia, we were already expecting rate hikes to be taken up. It just got a bit moved forward by a quarter. And honestly, they don't really have that big a problem. I know it got a lot into the media, but if you just look at their currency performance relative to other currencies like Argentina, or even for that matter, Brazil's currency, it's doing okay. So I think it just got a lot of bad media, but underlying fundamentals are fine. So broadly, EMs are doing okay.
Okay. No, I just want to point out to one article written by Dr. Urjit Patel in the Financial Times day before yesterday, where he is saying that if the Fed is shrinking its balance sheet at a time when the US government is going to borrow more, and therefore Dr. Patel argues that dollars will flow towards US treasuries. His fear is, and he quotes data to say in the last 6 weeks, every week $5 billion has moved out of EMs. So he's asking the Fed to roll out its balance sheet shrinkage by a few more months. That seems to be the crux. Would you worry on those lines that dollars may flee emerging markets because of what's happening in the US?
I think that is definitely a risk. But I think what is different, as I mentioned to you earlier, compared to 2013, is that the EM fundamentals themselves are fine. Look, whenever you see strength in US data and pick up in inflation, the US 10-year bond yield moves up. And at that point of time, you do see a temporary rise in the dollar and therefore some kind of EM assets repricing. We've seen that in November 16, we've seen that in November 17, and we've seen that now. Fundamentally, we think that the dollar is going to be weak. It had this tactical rally and it's going to roll over. And the reason for that is that rise in fiscal deficit in the US is going to cause widening in US current account deficit. So in that sense, it will be somewhat similar to 2003 to 6, where the Fed was hiking, but you saw that the US current account deficit was widening and dollar was weak and EMs were fine.
It's always good to think that something like 203 2003 to 2005 or 6 is on the cards. That's the great growth story everyone wants without the negativity. But speaking of Governor Patel, what's your sense about the Indian financial conditions? Do you think that, are you expecting 1, 2 rate hikes and one today itself?
No, we don't expect the central bank to hike today. Of course, there's always a possibility. But I think looking at the fact that the underlying inflation trend in India is fine, and ultimately that has been the framework that the central bank has provided us. So looking at the trend in inflation, particularly food inflation, which is a big component, it doesn't worry us that the underlying inflation trend is quite okay. On our forecast, we expect the core inflation in India to be going to around 4.3% by March 19. So we think that the trajectory is looking comfortable with the facts that we have. But if you do see a big problem on oil and oil shoots up in a short span of time, then there will be that inflation pressure which the central bank will have to consider. But I think with the facts that we have, we think they should probably hold today, sound a bit more hawkish and say that, look, that easy monetary policy condition that we had so far is done, and one should be prepared for interest rate hikes in future.
Okay, so a hawkish pause would be more like it today.
Correct.
But for 2018, what are you expecting in terms of rate increases from the Reserve Bank? Will it come in August? Will there be more?
So we see one base case rate hike in last quarter, but we do appreciate the fact that oil prices have moved a bit higher than what we were building in our forecast. And so there is a risk that they could do a rate hike in August.
Okay. Oh, in August. But you only expect one and done?
No, we're expecting 2 more. So in all 3 hikes in our forecast horizon. So it will be a shallow rate hike cycle. Okay. Unless you see a big misallocation or redistribution by the government before election, which then brews up inflation in 2019.
So you expect them to point out to those risks?
Absolutely.
So, MSP is one fear that everyone has, and as well farm loan waivers. So if the fiscal deficit were to expand, you think that there would be more than one?
Absolutely.
Okay, let me come to the currency. While of course we are not in the category that Indonesia is, or definitely not anywhere near Turkey, what's your sense? Is the rupee appreciating too much, and therefore a rate hike can actually hurt? In real effective exchange rate terms, just about before this current bout of depreciation, we were overvalued last year. Now I think it's come down to whatever, 15% or 16% overvaluation. So, what's the sense you're getting in the rupee itself?
So look, I think the fundamental valuation of the currency that we look at would be in conjunction with terms of trade. You can't just look at real effective exchange rate and versus trend and say it's overvalued. So we think currency is relatively fairly valued on that metric if you consider terms of trade in the background. And the other evidence is that the trailing current account balances have been fine. So that's also telling you that the underlying valuation of the rupee is fine. And so I think the 2 variables which we need to consider. First is what happens to the dollar. We always look at rupee in isolation. Everybody asks me, what do you think about the rupee versus the dollar? My counter question is, what do you think is going to happen to euro versus dollar? And so if you see even the recent bout of depreciation, the rupee is actually moved in line with euro, in fact done better than euro.
Yeah,
so
it's much more stable.
It's a function of what happens to the dollar. And as I mentioned earlier, our FX strategy team is forecasting that the dollar will decline. Okay. So I think from that perspective, you should have reduced pressures. And then the other thing is what is going to happen to commodity prices, because terms of trade is also another variable. So if commodity prices rise, then it makes sense for the rupee to depreciate and adjust in line with the terms of trade deterioration.
Okay. Well, the only worry is that we could be headed for 2.6, 2.7 current account deficit in the current year, partly because of crude and partly because our exports are not firing up as much as global growth would expect of our exports. You don't have fears about current account deficit?
No, again, I would go back to 2003 to 6. We had oil prices going up from $30 to $90 from 2002 to 2007, and current account deficit remained around 1.5% of GDP. At that time, our
exports fired. Now you're not worried?
Correct. So the difference is that at that time we had a global environment which was good. Now, global environment is not as good, so exports will not be growing at 25%, but they can definitely grow at 10, 15%. So that will be an offset that we need to consider. And then the other backdrop was that it was a productive growth environment. We were not generating growth through misallocation of, by loose fiscal policy or low real interest rates. And so to that extent to which right now we do have that backdrop, that growth is recovering in a productive manner, then you should be able to see that India's exports actually do pick up. I think 1 or 2 months weakness is not something that we are looking at and getting concerned. So our forecast is that the current account deficit should be remaining on a 4-quarter trailing basis in the range of around 2% and not really widening up to 3%.
Oh, that's good to hear. Just a word back on growth. There could be, as you say, 1 rate hike. There are some out there who are predicting 2 rate hikes in 2018. What happens to growth? Is this going to be a good year of growth, 7.4 as the RBI had forecast, or less than that?
So on growth, our framework is that you needed a period where you have synchronous recovery in exports and consumption. Look, since the time taper tantrum happened, we have not had either of those. Either you had consumption, at that time exports were bad, or if exports were coming back, we had demonetization holding back consumption, etc. So since last quarter of 2017, we've had a normal environment for both consumption and exports. Capacity utilization has therefore started to improve. So we think growth is actually going to be now finally delivering in the way investors were expecting. It's been a long wait, but finally it's coming through. Look at two-wheeler sales on a 2-year CAGR basis, commercial vehicles, cars. Hindustan Unilever's volume growth in March quarter was up 7.5%. So we are seeing some kind of broad-based recovery right now, and public capex is also doing well. So.
Okay, that's quite an optimistic view coming in there from Chetan Iyer of Morgan Stanley. He says no rate hike today, not concerned about the inflation situation. In fact, growth is recovering in a productive manner. More on that later through the course of the show. For now, let's drill it down to the micros. We'll take a short break, come back with CNBC TV 18's top 10 list of stocks to watch. Stay with us.